You're listening to the Brick by Brick Podcast.
Welcome back to the Brick by Brick Podcast. I am John Errico here, as always, with Ryan Goldfarb. We are very excited to bring you another episode of the podcast, and thank you to so many for listening and providing us your feedback and thoughts. We really appreciate it. Today, it's the end of 2021, nearing the end of 2021. We're in December right now. We thought it'd be fun to do a retrospective on the different properties, projects, etc., things that we've done. Ryan has prepared some financial information that I think will be helpful and some other details, but we've had quite a year, I would say. It's been a very eventful year.
It sure is, especially when we compile all this stuff and look back. It's crazy to, when we're in the midst of a project, it's easy to lose sight of like when the bookends are, like when the year began versus like when we just bought something and we're in the planning stage and trying to consummate some of these projects. But I think having the year to use as a bookend for certain milestones is definitely helpful. And I look forward to doing this again 12 months from now and 12 years from now and seeing how different things look then too.
Yeah, so I think I'm trying to put myself back into where we were at the end of 2020. So I think one of the biggest things that we got off the ground and have sort of completed doing, that's going to kind of, provide context for some of the specific projects that we're talking about. But we, at the end of 2020, we started putting together this fund that we have now launched. And just for anyone listening, this is not a solicitation for your investment. I'm just describing
It's already closed.
the occurrence. Yeah, it's already closed. And that's the Liberty Hudson Opportunity Zone Fund 1 entity. I think at the end of last year, we had maybe just, like around this time, 12 months ago, we had maybe just put together those documents. And now, 12 months later, we've finished fundraising for that, and we started deploying capital. I think we've deployed basically almost all the capital we're going to be deploying from that entity. Maybe we have a few more projects in the works. But that, we've talked before on this podcast about private equity funds, all of that. That was a huge undertaking. I mean, we've been talking about doing something like that for several years, really. I think back in 2019, at least, maybe even 2018, we talked about that.
Yeah, I think it really took getting to the second incarnation of that idea for it to become reality.
Yeah, I didn't even know what an opportunity zone was. I think more than 12 months ago I did, but maybe not 18 months ago.
Well, we first talked about it. Yeah, we first talked about it when it launched, and I think at the time doing something like that seemed too daunting to be attainable to us.
There are a lot of uncertainties.
Yeah, and I think our initial interpretation of what the program entailed led us to believe that we were going to have to do these like massive renovations on like a $10+ million buy on a single asset, and that just seemed a little bit out of our depths at the time.
I think that is what the law was organized for. We have a whole other episode on this specifically, but what Ryan and I are talking about is that we have a fund, which is essentially a pool of money that we're investors in and other people are as well. And we invest out of that pool in an opportunity zone, federal opportunity zone, which is a specific federally designated space, if you will. It's different than urban enterprise zones or whatever else. It's a specific thing to this program. We invest exclusively in one particular zone in Atlantic City. So the fund that we now run operates only in Atlantic City. So we're only doing investments in Atlantic City, and primarily it's existing single-family, two-family, smaller properties that we are using almost exclusively for short-term rental purposes. So again, we have episodes on short-term rentals. We talk about we're doing Atlantic City a lot in the past. So this is that. 12 months ago, it was in the embryonic form, and I would say today it exists, which is very cool.
Yeah. So I started compiling some quick facts from 2021. If we want to start with acquisitions, I have those broken down by vacant lots we acquired, rental buildings that we acquired, and what is going to be our pipeline leading into 2022, which are the properties that we're under contract on.
Let me, just to provide some context as a means for comparison, let me try to recall where we were at the end of 2020 in terms of the properties that we had. I guess we can focus on Atlantic City, perhaps.
Yeah, I think holistically, obviously our focus now has been short-term rentals. I think it might be helpful to paint the picture of where we were with short-term rentals going into 2021. which I think was, we maybe had 8 listings. I think we had 6 in North Jersey, we had 1 in Connecticut, and we had 1 in Atlantic City. We
had 1. We were about to have 2.
Right.
Right.
We were about to have 2. We were 2 more. We were bringing on.
Right. So we had
after.
1 that had been in operation since the beginning of July of 2020.
Right.
And we had purchased by this point last year, we had 3 more properties that we had bought. If I'm remembering that correctly, earmarked for short-term rentals.
Yeah, I think we had Beach, Murray, and New Hampshire.
Yeah, New Hampshire, right. That's what I'm thinking.
I think we were maybe under contract on 1 or 2 others.
Could be. Yeah.
I think we really started the buying spree in earnest in 2021.
Right.
So, which leads us to, I guess,
we were under contract for Westminster, I believe.
Yeah, we closed 163 in 2020. We closed 161 in 2021 because of the fire.
Okay. Yeah. So yeah, we had a few more in the pipeline. But
So I guess let's pivot into what we did in 2021. So I'll start with vacant lots. Going into 2021, we owned 0 vacant lots, and in 2021 we bought 21 lots. And I would say that those averaged in size to be about like a 30 by 100 lot. Most of these I would say are buildable on their own. A few of them we purchased because we were targeting a few lots adjacent to one another to do something a little bit bigger or to make it a little bit more worthwhile.
Yeah, I think for people that don't live in the Northeast, when they think a lot, they think like a half acre or something like that. So these are small lots. Ryan is talking in feet, so 30 feet.
Yeah, and I also paint that this is like an urban context. So even 4,000 square foot even a 4,000 square foot house that we have sits on, I think, a 44 by 100 lot,
right,
which is 4,400 square feet.
And that would be a lot of frontage for a lot. Yeah.
Yeah, that's a good size lot for a single family in Atlantic City.
So the context for why we're buying these vacant lots is that we have, as we talked before on the podcast, we're big believers in Atlantic City, both in the context of the kind of immediate cash flow opportunities, but also in the medium, longer term, Atlantic City improvement kind of thesis. So the stuff that we're buying is in a couple of different areas of Atlantic City, but primarily it's in an area that we're very bullish and optimistic about. And we're trying to kind of be conscious of the fact that area might change and try to position ourselves in a way where we could do ground up development. And so for Atlantic City, doing ground up residential development is huge, because there really have been almost no ground up residential developments in many, many years. I mean, I think I can think of maybe 3 single family or maybe small multifamily houses that I can immediately think of. Obviously, there have been bigger condo type apartments, maybe
one big one.
Yeah, maybe over 10 years ago, I would say.
No, I think that was more recent. I think that was within the last 5 years it came on.
Was it? Okay.
I think it came on market in the last 5 years.
Yeah.
But I would say the other big thing development-wise has been Stockton's presence. They've done a lot of new construction there.
Right.
But that's obviously not single-family homes.
Right, and obviously there's Atlantic Cares has a huge project going on, but yeah, not residential. Right. Yeah. So we if and when we do that, we'll be among the first doing ground up residential. Actually, some of our friends that we know are doing ground up residential as well, but it's all kind of in the same wave of development. So we're very, very excited about that.
And I would say with each renovation project we do, we get closer and closer to wanting to do new construction.
Yes. Ryan was very excited when a few months ago I said that I was tired of doing renovations, and I still am tired of doing renovations. But unfortunately, when I said that, we were about to embark on the most renovations we've ever done. So...
All right, so that's 21 lots.
It's like saying I'm tired of having children as my wife is pregnant with another child. Which is, my wife is pregnant,
true.
But I'm not tired of having children. So.
Which is half true.
Half true.
All right, so we have, for 2021, we have 21 vacant lots acquired. And I want to say we have another half dozen or so under contract that will probably close in 2022. In addition, we purchased another 12 buildings. I have these classified as rental buildings. Most of them will ultimately be short-term rentals, but for the time being, we did inherit some tenants
Oh, I should add, Ryan, there is one more building that we didn't account for, which is not a short-term rental building in Atlantic City. Belfield Avenue.
I think we bought that in 2020.
Right. Oh, I'm sorry. We did buy that in 2020.
Yeah. I think we bought it like late 2020.
Ah, you're right. Is that?
Yeah.
In late 2020?
Like fall? Late summer?
Oh, okay. Maybe
late summer.
August.
I want to say it was like August.
Yeah, it was like August.
Yeah.
Okay. I think we were under contract for that for so long that
Yeah.
in my mind I was like, we must have bought it before.
I think we put it under. We first looked at it. It might have even been in 2019.
It was
and
in
then it
2019.
resurfaced, and then it was under
yeah.
contract for like
Mhm.
4 or 5 months, and then we finally closed. All right. So 12. We purchased 12 in 2021. I have just some quick numbers. I think the total purchase price or total as is value on those is about $2.2 million, which works out to about $185,000 a building. And I think based on our preliminary numbers, preliminary underwriting, we anticipate that post renovation, those will be worth in excess of about $4 million. Obviously, that's not all going to be equity or not created equity because we're going to be renovating them quite substantially. But we do anticipate that will force some appreciation on those. And I think based on where some of our appraisals have been coming in recently and based on what the market has been doing recently, I think the $4 million after repair valuation is probably on the conservative end. And then out of those 12 rental buildings, well, let's get into under contract first, and then we'll transition to our STR listings and our the composition of that portfolio. So we have another 6 buildings under contract, total of about 1.3 million, anticipated after repair value of about 2.2 for those. Again, similar concept. Some of them are more turnkey than others. Of that 900,000 in Delta, we're probably going to be putting in somewhere in the range of $500,000 worth of work. So I guess with our current portfolio, what is under contract, our pipeline, or by mid 2022, I think we'll be at about 34 properties across the board with about 50 STR units. This is plus or minus a few for some properties that we have targets on that we don't necessarily have signed contracts on yet. And I think we'll be right around the $10 million valuation, or right around the $10 million mark for portfolio-wide valuation as is, and I assume we'll be quite a bit above that after we finish all of our renovations.
Yeah, so I think in the span of about a year, I mean, obviously some of these things were in the works before this year, but in the span of about a year, that's a tremendous amount of buying and effort and whatever else. And put in that context, it seems exhausting. So I'm tired just remembering that happened. So.
And the other way to think about that is there are many people who go and do their first deal and buy a $30 million multifamily for with 200 units and do what we've spent the last 3 years doing in one deal.
Yes. Well, that's another way of thinking about it. So,
but I choose to sit here and pat ourselves on the back.
And not all of these, I would say that a lot of these purchases were through the fund, but several of them were not through the fund. They might be JVs with other people, or Ryan and I might have just been able to take them down ourselves. So, what one of the big things I should say with Ryan reading out these numbers, it kind of maybe lost in some of those numbers, was that the purchase price for these properties was very low. But the reason why that is that most of these properties were not in habitable condition when we bought them. And not in habitable condition means like require complete gut renovations. Even some of them that were occupied, I would say, were not occupied in standards that most people would consider to be sufficient for human living. So I'm trying to think if any of them are really, I guess maybe one of them were doing almost no work. Maybe one of them we
Windsor?
did almost no work. Windsor, and then Texas, I'm thinking we painted.
Yeah, I would say the most turnkey properties that we've bought, we've probably put in $25,000 worth of work.
Yeah. So for most people, I'd say you buy a property, put in 25,000. It's not
Right.
exactly turnkey.
Right.
But it's funny. Ryan and I were discussing just earlier about some of the minor renovations that we're doing, and one minor renovation that we have coming up is completely gut the kitchen and replace it, completely gut 3 bathrooms and replace them, and create 3 new bedrooms out of 1 existing room, and also put in a new HVAC system. So that's a minor renovation, relatively. It's turnkey. Yeah. Someone was living in there. I mean, not when
That's
we
true.
bought it, but someone had lived in there before. So
That is true.
I guess that's true of every house. Someone had lived in there before.
I guess I wish I had some better prepared averages on some of these projects, but I would say just from looking at these, I would say like our average purchase price, or like the range of purchase price on these properties, has been between about $100,000 or $75,000 and about $250,000, and the average renovation is probably in the like $175,000 range. But that fluctuates from, on the low end, as you just described, $30,000 for something that's quote unquote turnkey, to, I think our our largest construction budget is like $450,000 or so
that we spent.
that we're going to.
Oh, okay. I
Yeah,
don't
I think
recall
Pacific
spending.
is going to be close.
Yeah.
That'll be close to $500,000.
I was trying to think of what we spent $450,000 renovating already.
You don't remember that one thing that we spent? Yeah.
Again, we're one of the reasons that we talked about this in another episode too, but one of the reasons that we are moving away from doing renovations is because when we talk about doing a renovation for $450,000, it's almost the case that you could rebuild the building for that cost. In fact, you probably could. The one reason we don't do that in some cases is because we wouldn't be able to take advantage of some of the, I guess you could say, grandfathered attributes of the building, like the fact that it has more units than zoning might allow, or doesn't have parking, or doesn't have something like that. But notwithstanding that,
lot coverage is also
lot coverage. Yeah, notwithstanding some of those things, we would do it. So yes, so it's we're sort of gearing ourselves up. And I mean, I've already felt this in the past like 2 months. We're transitioning from acquisitions to construction, and it's a lot.
Right.
It's a lot.
So, looking at the short-term rental activity from 2021, we put 8 new listings online, and those are, say, a combination of single-family homes and apartments within small multifamily homes. Our current pipeline, and I would say these are like the active construction projects that we have going on right now that John just alluded to. I think that will amount to another 14 listings, the majority of which we really hope to get online by the end of next summer, because as we've talked about in other episodes, the nature of revenue in a short-term rental market like Atlantic City is that the disproportionate amount of revenue comes in the summer months. So there's a big difference between getting something online on Memorial Day versus Labor Day,
Right.
even though it's only 3 months apart. And then we have another 12 listings under contract in some capacity. Again, these are some single-family homes and a few multifamily buildings where we intend to convert some apartments or renovate some apartments and then list them as furnished rentals and vacation rentals.
So I'm curious. I mean, I think we talked about this a little bit, but to figure out some of the revenue numbers, because they've blown me away. I think they've blown our estimates away from what we thought. Obviously, before we went into these purchases and before we launched the fund, we did a lot of underwriting and thinking about how much these properties would generate, how they perform relative to other properties that we've had, et cetera, et cetera, et cetera. I think in almost every case, our properties have exceeded those expectations, which is great.
Yeah. I mean, one nice thing about actually doing underwriting when you go into a project is you can compare the actuals with the expectation. And I remember we talked about this recently, but for some of our early ones, for these single family homes that we were renovating and planning on putting online as short-term rentals, we were expecting 45 or 50 grand a year in short-term rental income.
We thought those were home runs.
Yeah. So going in, we were excited about doing these projects, even with the expectation that we'd be bringing in $45,000 or $50,000 a year net. And on that one property that comes to mind specifically, we're pushing the $70,000.
That's our first short-term rental together.
Right.
Yeah, that was the one that we launched in
July of 2020.
Right.
So yeah, we were about a year and 4 months worth of activity on that so far.
Right.
So across the entire portfolio, this is just we're recording this on December 7th of 2021. So from December 8th of 2020 through today, which is a full 365 days, our gross accommodation fees across the board, across I think it's 17 listings included here, is $778,000. I would net out two of those listings are properties that we manage third party but don't own. And if I take those two out of it, we're left with $674,000 over the past 12 months, which is, I'd say, pretty darn good, considering what our expectations were. And I mean, when I look and break this down listing by listing, I would say there's not a single listing that doesn't amaze me by its performance.
Right.
And I think the craziest part is I think that these are going to look even stronger over the next 12 months because a lot of these we struggled to get online for what would have been the peak earning months.
Right.
And next year, I think that that's going to be a true home run. So the nice thing about getting some of those listings on a little late is that by the time next summer rolls around, we'll have a well-established listing, which will make it even more attractive than
Good
it otherwise would
reviews,
have been if
track
it came
record.
online in July 4th.
Exactly. Yeah. I think I'm still amazed. What was that single month, Ryan, where we had our property, what did it make? $30,000 in a single month. Yeah. Which is a little bit maybe misleading because there might have been some bookings kind of at the end of the prior month and extending into the next month, but it's still, even with that, it's still astronomically insane.
And so to be clear, that include our entire portfolio, which consists of a few listings up in North Jersey as well. So if I break this down to just Atlantic City, which right now is comprised of 10 listings, one of which is a sort of duplicate listing. But across all of those, the past 12 months was $436,000. And I think our pipeline for next year, I guess a lot of this depends, like our expectation, I think, is going to be largely driven by when these listings come online. But I think if we were to say like the stabilized expectation for the pipeline we have and that we're working on, I think we're looking at estimated, we're looking about another $1 million a year. Sorry, about $1.8 million in annual STR income off of the current pipeline, which consists of a lot of those fund projects we talked about. A few things that we're under contract on, a few multifamilies that we have slated to convert to short-term rentals. So yeah, I mean, it's kind of crazy to see those numbers, but I think for what this is worth, the total portfolio that I just that I benchmarked at 785 to or something like that. I think for extrapolating out a full 12 months of rental activity, I think that portfolio should be at a run rate of about $1 million a year.
Yeah. So to be clear, the numbers that we're using, impressive though they are, a lot of those properties didn't come online until the second half of 2021.
Right.
Because we bought them, as we said, at the end of last year, we only had essentially one property under contract. So we put them under contract, closed on them, renovated them, and then put them online all in the span of, the first 6 to 8 months of the year, essentially.
Right. So if we take that current portfolio and extrapolated or anticipated a full 12 months worth of activity, we'd be just shy of 1.1 million in annual rental income. And then if you take what we have under renovation and under contract, we are looking at close to another $1.9 million. So we're essentially talking about tripling the number of active rentals or the amount of active rental income off of this portfolio once we get everything we have on our plates right now fully delivered and fully stabilized.
Which won't happen in 2022.
No.
But maybe by 2023-ish or so, I think that's realistic. Right. Yeah.
And then the gravy on top of all of that is the 21 vacant lots that we talked about, plus others that are under contract. Eventually, at some point, doing new construction and putting more listings online from those lots.
Yeah, exactly. So I think it's important. I think when you look at these numbers to say these sound like humongous numbers, but we're talking about, and they are humongous numbers, of course, and we're super excited about it, but we're talking about revenue. We're not talking about, income or profit. And we're also talking about revenue that's split among our fund and also ourselves and also our partners and everybody else. So, to us in our pockets, we're not taking home anywhere near this amount of money because these properties cost a lot to operate. Several of them have mortgages that we have to pay as part of their monthly cost, or we will encumber with mortgages at some point in the future. And also, we're splitting the pie with many, many, many investors, depending on our relationship with them, depending on the properties. So,
to be clear, we do not make $1 million a year.
No, but it's a little bit tougher to. I don't know if you have these numbers right. It's kind of harder to extrapolate, but it's a little bit tougher to say, well, what is our actual profit, per year, because our expenses for some of these properties are a little bit variable, and also when you're talking about renovation versus a repair versus a maintenance or whatever, it's hard to tease out exactly in some cases because sometimes, it kind of bleeds into each other for accounting purposes at least.
Yeah, I guess our primary compensation for these projects comes in two ways or in two forms. One is the property management fee that we collect off of these, which again is not even a net. That's not itself net income to us because there are expenses that we have at the property management level.
So just to clarify, we run a property management company and we take a fee from these properties, a percentage of the revenue. However, that fee to us is not profit. It's just part of our compensation that we then pay out to other aspects that keep the property running. For example, people that help with maintenance, people that do repairs, people that respond to messages, et cetera, et cetera.
Right. So if we have on $1 million in gross rent, if we take a 15% management fee, of that 15%, we are maybe netting 8 or 9 or 10%.
Right.
So in this instance, that would be gross property management fee of about $150,000, netting down to just under $100,000 or so. And then the second form of compensation that we take from these projects is cash flow. I wish I had a better estimate in front of me, but I would say somewhere around 25% of gross rents we're probably clearing on an annual basis. And that is, that's after obviously paying mortgage taxes and insurance, but it's also after paying management fee to ourselves. It's after paying repairs, cleaning, replacing furniture, any capital expenditures that come up for a given year,
landscaping, snow removal,
tax
whatever.
prep for every entity, all those sorts of things, bookkeeping expenses. So I would say that's like a decent estimate of what our net profit is on each project.
And these are, again, not flowing necessarily to us. They're flowing to us and our investors in whatever capacity. So, in some cases we get more or less than we do on other projects.
Right. And there's also generally a fair amount of cash that we're floating for any given project. So even if, for a given project, we may be quote unquote stabilized and finally have it listed and rented and be generating income at a nice clip, but we may still be sitting on $20,000, $30,000, $40,000, $50,000 in cash that we have sunk into the project for a combination of construction or the down payment or furniture. So all of those things are variable. I think at the end of the day, no matter how you slice it, the rate of return is high, but translating that into absolute dollars on properties of this size is not always as life-changing as you might think.
Right. So it goes to the complexity and kind of difficulty of running a real estate company and business, because I think a lot of times you read online about, oh my gosh, this person or whatever is generating so much money in rent or in revenue or made so much money in a flip because they bought it for $200,000 and sold it for $800,000. But you're not thinking about the expenses, the carrying costs, and also the splits with investors and other partners that are involved in these projects. And of course, in our case, we have all those things, and even more so because the operation of short-term rentals is, I would say, much more intense, both from a time and financial perspective, than it is a long-term rental. So our expenses are relatively quite high. I think, as Ryan said, our returns are great and really excited about that. But, just to kind of color some of these numbers a little bit, I think we've done a little bit of a deep dive into some of our projects in the past. It might be worthwhile to do a deep dive into one of our currently operating properties to look at exactly how money comes through and expenses are spent and all that sort of stuff to give more perspective. But it's great on a portfolio level, but it's a lot. It's the revenue numbers only tell one aspect of the story.
Yeah, and I think just to speak to that too, we're at the point now where obviously there's some scale to this operation, and I think what makes a lot of these things more tolerable or increasingly tolerable is that we are simultaneously growing but building the infrastructure to grow with it. So I can't imagine, our first few properties that we had as short-term rentals that we were operating were in North Jersey, and I think at the time we had 6. I think at the peak, or what we have now, and at our peak we maxed out at 6 listings, and I think that was probably at the limit of what we could manage ourselves without full-time personnel to help with maintenance and various construction tasks and
Yeah.
the errands that come with keeping people happy.
Well, that was my full-time job before we started
Right.
working. I had a bunch in Hudson County. I don't know how many of the total. It was over 20. They're individual rooms, so it's a little bit different than a whole apartment. But that was a
More
full-time
rooms
job.
is more headache. More rooms,
Yeah,
renting a 4-bedroom house to 4 different people means you have 4 different people that you're
yeah,
listening to complaints to and that you have to keep happy versus one.
yeah, exactly. Yeah,
for.
but that's a full-time. That was a full-time job for me for a period of time. Yeah,
Right. So I think what makes all of this a little bit more tenable, at least to me, is the fact that as we continue to grow, I think we're working on building out the infrastructure to be able to handle that additional growth in a way that's sustainable for us, that's sustainable for an actual business, that's sustainable to our operating partners on the ground. And I think that's really important because for a while, I think I've come to the conclusion that in this space, you can only run lean for so long without either burning out or, I don't really know of an alternative, growing without burning out or coming to this realization.
imploding.
Yeah, coming to
What's the
this
opposite?
realization where you have to pivot to, paying for a higher quality contractor,
Yeah.
paying for a property manager who's going to be able to carry their weight,
Right.
paying for a handyman who's going to be able to do what you need them to do, and paying for
Right.
cleaners who are going to be able to do what you need them to do. So I think we learned that lesson early, relatively speaking, but it was still several years worth of being a lot more involved in certain things than we otherwise.
Yeah, I think the
should
funny
be.
thing is that we're sort of right now pulling our hair out about a lot of this stuff, and we're trying to figure out a way to scale better and et cetera, et cetera. But relatively, it hasn't been that long where we've had this kind of like emergency problem. I think a year ago we were talking about it, but I think it was a little bit more like, well, when this happens, or when we have these projects coming on, and now it's like, well, we do have the projects that have actually happened. So now it's like, whereas it last December it was kind of like we should really think about it and get ahead of it. Now it's like we have an emergency. So
Yeah, I mean, I think we talked about this in a recent episode, but our current pipeline is 10 renovation projects that we own that are more or less active, plus another 5 or 6, depending on how you classify it, that we are under contract on. So that's certainly over a dozen considerable renovation projects, totaling probably $2.5 million worth of renovations. So I mean that's an operation. I mean
Yeah.
that's an operation on top of an operation that we already have with our existing portfolio.
I think the cool thing for us is that it wasn't like in 2020 or in 2019 we were doing nothing. We had a bunch of projects in 2019 and 2020. Ryan was finishing up or not finishing at the time, but was in the midst of his tax lien portfolio up here in East Orange, which is now almost complete. You're selling the very last one. I had a bunch of projects in Hudson County that were ongoing. We did some flips throughout Essex County. So we had a lot of stuff going, but the cool thing is like, if you look at a graph, right? If you said like whatever metric you want to graph, like number of properties, revenue, number of construction projects, money spent in construction, whatever you want to say, in 2019 or in 2020, it was at some number, which I think a lot of people would say like, that's kind of a good amount. And then in 2021, it's just like, it's a lot more, and in 2022, it's going to be a lot more than that. So I think, from one perspective, it's like, oh, it all happened overnight. But I think from my perspective, and you probably share this too, Ryan, it's like, well, that all that happened in 2021 and that was great, but it took the, 6 years that we were each doing it, sometimes apart and sometimes together to get to that point. It's kind of like all the experiences, the connections, the, good and bad that happened that 6 years really primed what happened last year or this year.
And to your point before, it wasn't like we sat down at one point 12 months ago or something like that and said, okay, we're ready to scale.
Mm-hmm.
What happened, like all of this was gradual. I mean, obviously we had the intention of launching the fund. We had started fundraising for the fund, and that I would say gave us a little bit of fuel to start buying a little bit more aggressively. But I think the idea of, hiring a full-time construction manager and really building out a fully fledged vertically integrated operation was not something that we really set out to do, or that we really, I would say, intentionally pursued over the last 12 months. But I think kind of like a testament to the power of perpetual motion that, if you just keep acting and keep doing and keep making progress, you're going to get to that scale, and then those opportunities will, or those necessities, I should say, will present themselves. And I think the nature of being an entrepreneur is, as those necessities present themselves, you figure out the way to solve them.
Yeah, I think the cool thing is that for a long time we've been talking about like trying to really go all in on an opportunity, because we've dabbled in different things, different markets, different types of. I mean, dabbled is maybe an understatement. We've spent a lot of time in different markets, different projects, and we finally found something in Atlantic City that we felt passionate about and kind of made sense financially, and all the stars aligned, and we said, like, let's really go all in on it, and that's where we are now. And it feels really good. It also feels very stressful because we're sort of at the beginning of it. All of the, like, we have a lot of projects that we have a fair number of projects that are now online, but we have many more projects that we are about to get online, but we have to do all the work to get there. And now we have investors that are depending on us, that are hoping that we're going to do what we said that we're going to do, which, of course, I feel very strongly we are, but it's just a matter of executing. So it's a different type of stress.
I don't
it's
know
not like
about,
an existential, like, what should I do? It's like, I need to execute stress.
I would say there's a little bit of a feeling of being overwhelmed by the sheer volume of what we have to do. But I would say I feel infinitely more confident now than I did 12 months ago about the scale of what we have to take on right now. I mean, that like $2 or $3 million worth of renovations, it's very easy to break it down on a per project basis. And if you look at it that way, it's basically rinsing and repeating what we've been doing on a few other projects. Right. And I think I disproportionately get overwhelmed by things that are newer.
Why don't we finish this episode by talking about the things that we're excited about doing next year, and then kind of setting it up for what we're going to talk about in 12 months. I think one of the things I'm most excited about, notwithstanding all the different projects that Ryan just talked about that we're closing or that we're renovating or that we're hoping to start renovating, I'm excited about doing new construction, which I think is going to happen in some form next year. Not sure on which lots it will be or when, but I think it will happen, which will be a huge milestone for us.
Yeah, I think in 12 months, I hope that we have some form of approvals. I don't know if it's realistic to think that we'll have already broken ground, but I think I
think it's possible.
Yeah, I think for sure I'd like to see that we have approvals, like land use approvals, and know what we're going to be building, and then just be at the phase where we're working through exactly how we're going to do that and getting permits and getting the subcontractors lined up, and maybe it's prefab, so we're engaging a prefab developer. But yeah,
we have not part of this discussion. We're also investors in other projects as well, where we're not necessarily running the ship, we're not running the boat, but we have money, for example, in the mini golf project. True. And we had Nick on the show a few episodes ago to talk about that project, but we're investors in that project. We're investors in a big project on Block 51 in the Orange Loop, which is going to have itself new construction going on. So even if it's not necessarily our project where we're like quarterbacking it, just being involved in some way is very exciting and very cool. So I'm looking forward to that. And in fact, I think that the mini golf project, as of possibly this week, has broken ground. So
yeah, there's finally a building permit issued. So I think I think the first step is starting construction on the bridge that's going to connect the boardwalk to the mini golf.
Exactly. Yeah. So that's, I think if we can do that next year, that'll be a huge win. I think if we can say that we've substantially gone far towards renovating these projects, that'll be a huge win. I mean, we're we're really, maybe 40% done with one project, maybe less than that, something like that.
Yeah.
We're maybe 10% done with another project, and then we're 0% done. I guess if you count demolition, we're a little bit further, but we haven't started construction on a whole host of other projects, and that's about to happen. So the next, between today and June, we're going to start construction on probably 3 or 4 buildings, construction meaning renovations, 3 or 4 buildings, and hopefully complete construction on the other 2 or 3 that I just talked about.
Mhm.
So
Yeah, I think my North Star is increasingly rental income, gross rental income. I
Yeah.
think that's probably the best barometer for progress for us. So I would say if we're at like a $1 million run rate now, $1 million annual run rate now, if we can double that by this time next year, I would consider that a huge win.
that'd be awesome.
Might be a little bit ambitious. And I would caveat that by saying that I would say there's almost zero chance that we will have collected that much in short-term rental income over the next 12 months. But I think if we take our like trailing 3 months to end 2022 and extrapolate those numbers out 12 months, I would hope that average monthly number works out to a run rate of about $2 million a year. I think that'd be a huge success.
That would be awesome. Well, I hope you guys have enjoyed this kind of recap of our 2021. If you guys have any questions or thoughts or comments, as we say every episode, we love to hear from you. And I think every episode we hear from at least a few of you about thoughts or, want to reach out, and that's great. If you want to contact us, the easiest way is by email. I am John, JOHN at libertyhudson.com.
And I'm Ryan, RYAN at libertyhudson.com.
If you can follow or like or subscribe to this podcast on however you listen to the podcast, we would really appreciate that. It really helps us out to know who's listening and what you guys like to hear. But until next time, thank you guys so much for listening. We'll be back next week with a new episode of the Brick by Brick podcast. Thank you.
Thanks.
You're listening to the Brick by Brick podcast.